Hi, I'm Finucane, Chief Investment Officer at Oxbow Advisors. Today we're going to walk through shifts we're seeing in the equity marketplace today, why we expect economic growth to decelerate this year, and why, despite the recent market volatility, we're still not about to rush in and put our cash to work just yet. First, we want to walk through some of the shifts we're seeing happen in the equity market. Most of the time, companies are going to set up their performance so that they beat expectations when they report earnings and revenue, as well as beating expectations when they issue guidance looking into the future to the next quarter or the next year for those profits or revenue. And in the last 2 years, we saw a greater beating of expectations than we've really seen historically, thanks to the resourcefulness and resilience of workers at these companies around the world, and thanks to the help of the stimulus provided by central banks and governments globally. However, the stimulus is going away and expectations are returning more to a normal environment. And what we're seeing, if you look at the far right side of this chart, is that more companies are now reporting guidance that disappoint expectations than beating expectations. And we think this is going to be a choppier year where you really want to own outstanding businesses that can still deliver regardless of the underlying environment. The next thing we're seeing that surprised us is that investors that manage money for equity funds have really moved into late-stage cyclical sectors like banks, energy, and materials. What this suggests to us is investors are anticipating inflation to remain at a very high level for this year and looking at further out into the future. But if we compare this to the previous 3 times that we saw this high of an overweighting of these sectors compared to an index, these sectors tended to underperform the market over the following year. So this seems a little bit like a late move, and so based off looking at this, we feel okay that in our long-term growth portfolio, we don't own much in the way of these sectors. On the opposite side, we've seen investors really pull out of the tech sector, and we've seen the NASDAQ correct over the last couple of months. You saw the volatility happen in January, but what's interesting to us is the last time that fund managers had this little invested in tech compared to the index was December of 2008, right in the middle of the great financial crisis. And we look back, the following year after that December 2008 period, tech stocks went up by about 50%. We're not anticipating that there'll be a 50% return for tech stocks here because valuations are much higher today than they were. But it tells you from a sentiment perspective that we actually think tech stocks could outperform, similar to those previous 3 instances in the previous slide where we saw cyclical sectors where everyone wanted to be. Another narrative that we see right now is that consumers, as things return to normal, if the pandemic changes into an endemic stage and people are starting to live more normally going into the next couple of years, there may be this consumer spending boom because of an increase in savings in the last 2 years and the stimulus payments that were provided by the government. But we saw an example of this in the 1940s after World War II, where the savings rate increased for a couple of years, and yet spending returned to normal after that, because what families did is they tended to put that money into their investment accounts for the long term, or maybe they put it into buying a home, but it wasn't something that was going to go into their day-to-day consumer spending. And if we look at this chart, the trend line for personal savings rate, we're back to where that was at. So while we expect that consumer spending could still be decent, we're not thinking that it's going to be some incredible consumer spending boom. The other thing we're seeing within consumer spending is that we expect a reversion to the mean in terms of spending between goods and services. Without the ability to spend on things like travel and other services, people around the world were spending a lot more on goods, and yet we expect that to start to right-size itself as people start to travel more again. And we think this will be a beneficiary to our long-term growth portfolio with positions like Visa and MasterCard that benefit from a return to normal international travel, as well as Booking Holdings, which is an advantage of people looking for hotels to stay at around the world. Next, we want to walk through why we expect economic growth to decelerate this year and why that may mean a choppier stock market environment. First, a leading indicator for economic growth tends to be the flow of credit. How much liquidity and lending is being provided by governments and banks around the world, especially in the largest countries and regions. And if we look at this chart here, the dark blue line showcases that there's been a real reversal of the flow of credit. And when that historically happens, you tend to see a slowdown in manufacturing growth globally over the course of the next year. Now, why is that important? When you see a deceleration in manufacturing growth, so in this case, the blue line that currently is above 60 could work its way back down to 50 if you're looking at the right side of the chart on that axis. If that happens, it's going to be very difficult for the S&P 500 to continue growing at the same rate and appreciating. So we would expect over the next year that we would see a bit more of a choppy S&P 500 and overall stock market environment. Another takeaway from this slowdown in the flow of credit is that it tends to be a good environment for long-term Treasury notes and bonds. Basically, we would expect long-term Treasury yields to come down, as counterintuitive as that might be right now with everyone concerned about inflation and rising rates. Historically, if you're going to see a reversal of the flow of credit, yields will come down over the following year. And that's why we're comfortable owning a position in the long-term Treasury in our conservative income and high income strategies. Finally, there's been a lot more volatility to start the year, and we've seen a bit of a correction in specific parts of the stock market, whether it's tech stocks or small cap stocks. Even the S&P 500 had a more difficult start to the year than you normally see in January. But we're not in a rush to put that extra cash in our long-term growth portfolio to work just yet. There's a handful of reasons why. First, when investors are really optimistic about future returns in the stock market, they might take out margin debt, which is a way to try and take out additional money that they don't have to lever up their potential returns in the equity market, which is very risky. And you tend to know when fear has taken hold when there's less margin debt in the environment today than there was the same time the previous year. Right now, though, that's not the case. Margin debt is still higher today than it was a year ago. So we would want to see that margin debt roll over and be on the negative side, similar to other periods where you had better opportunities to put cash to work in the market. Next, this is the CNN Fear and Greed Index, which takes a handful of factors and puts them together to try and come up with an aggregate number between 0 and 100 to suggest how fearful or greedy investors in the marketplace are. We've seen this number in the single digits many times when people are very fearful. But right now, that's not the case. So even though we've had an increase in volatility, people are still thinking more aggressively rather than becoming worried about their portfolios, which tells us that this isn't quite the environment that we want to really jump in just yet. This next number is one that we track as well. This is the long-term appreciation potential estimated by the Value Line survey for the 1,700 stocks that it tracks in its universe. We've seen this number as low as 25% and as high as 180% in March of 2009 in the middle of the Great Financial Crisis. Recently, we've seen it more around 30%, and then recently it's gotten up to about 45%. But what that tells us is that for a projected 5-year return, that's not all that appealing. We'd want to see that number be significantly higher before we start to think that we're getting some of the valuations that we like. Finally, for the S&P 500, the price to earnings ratio looking out over the next 12 months tends to be a good indicator. For over 30 years, the average has been about 16 times. And for the last couple of years, we've seen an increase in that number to above 20 times. Today, it's probably about 19.5 times. But what we're noticing here is there's probably not a lot of opportunity in the marketplace if earnings per share growth has slowed down to the normal level of 8 to 10%, and yet we're still at this elevated valuation. So for us, we're not really thinking about what great opportunities there are going to be until we at least see this number get back down to 16 times, 17 times. And if you look at previous good buying opportunities in the market over the last decade, it's tended to get down to more like 14 or 15 times earnings. So that suggests we've got further to go down before we really start seeing great opportunities. We hope that gives you a sense of where we're seeing shifts in the equity market today, why we expect economic growth to decelerate, which would mean a choppy stock market but a good environment for Treasury bonds, and what we're looking for in order to get more opportunistic or aggressive in the stock market with our cash, but why we're not seeing that just yet. If you have any questions about that, please contact us.